Hello everyone. Let's start our today's discussion. I hope you all remember that in previous class we started discussion on basic income tax calculation of individuals. Let's take a quick review of the previous class and then we'll start our today's discussion. We started our discussion with the format of basic income tax return of individuals. In UK tax, income earned by individuals is divided in three heads: non-saving income, saving income, and dividend income. UK tax has defined different tax rates for each of these heads. So the first step is to classify the income. Non-saving income includes all incomes except interest income, which is classified as saving income, and dividend income, which is classified in its own head of dividend. Once we classify the income in these three heads, we arrive at the value of total income. Personal allowance of £12,570 is adjusted from it to arrive at the value of taxable income. Taxable income is the amount on which the tax rates are applied. We discussed the concepts of non-saving income tax rates, basic rate band, which is still 37,700, the tax rate is 20%. Higher rate band, which is from 37,700 to 150,000, the tax rate is 40%. And above 150,000, its additional rate band, the tax rate is 45%. Once we discussed the tax rates of non-saving income, we did two practice questions so that you people can have clarity on the calculation aspect. In the previous class, you all have watched my approach that first I introduce the concept and then we do the practice questions so that you people can get clarity on the working approach. Then we introduce the concept of real estate investment trust, which is a mutual fund. It raises investment from the public and it invests those funds in real estate market, the property market. Its source of income is rental income and capital gains. Okay? When a real estate investment trust distributes its income to the investors, it is treated as a non-saving income for the investors and withholding tax is 20%. I hope you all remember this. Then we did two practice questions in relation to real estate investment trust, that how we have to look at this advanced tax, the withholding tax, and we classify it as a non-saving income. Then we introduce the concept of dividend income, the profit distribution which we get from the companies. Dividend income has its own tax rates, but it is also dependent on the same tax bands. First £2,000 of dividend income are taxed at 0%, and there is no withholding tax on dividend income. We did two practice questions in relation to dividend income. Now, before starting our today's concept of trust income, what I'm doing is I'm making you go through one more practice question, and that involves the concepts which we have studied in the previous class. In this way, you will have a better revision of the previous class, and then we will introduce our today's concept. I want you all to listen to me very carefully so that you people can understand the rules. Okay, let's start. Mr. Z has following incomes for the year: employment income of 12,000, dividend income of 7,000, REIT dividend 4,000. Now, you all have studied in the previous class that dividend from real estate investment trust is treated as a non-saving income. And on this, the withholding tax is 20%. And since the examiner is silent, we will assume that this amount is net. Okay, this is the net amount. We need to gross it up. Let's look at it. We have two heads of income: non-saving income, and other one is dividend. Okay, look at it very carefully. Some basic revision of previous class. Employment income 12,000. Employment income goes in head of non-saving, 12,000. Then we have dividend income, 7,000. So dividend goes in head of dividend. Okay, the normal dividend which we are getting from the companies. And then we have real estate investment trust, dividend from mutual fund which earns from real estate market. So this is classified as non-saving income and withholding tax is 20%. So divided by 80% multiplied by 100%. So it is £5,000 gross amount. Okay. Once we have classified the incomes, we will arrive at the value of total income, 12,000 plus 5,000. So here it's 17,000 and dividend is 7,000. Some basic revision of the previous class. Then we'll adjust the personal allowance in it. Personal allowance is 12,570 pounds. Once we adjust the personal allowance, we arrive at the value of taxable income. Okay. So what will be the taxable income? 17,000 minus 12570. So it's 4430 and dividend is 7,000. Okay. See, we all have studied this in the previous class. It's a similar practice question to what we have done in the previous class. Just the objective of doing a practice question relating to previous class concepts is to give you a revision of the previous class topics before we introduced a new concept. Okay, so let's apply the text on it. Non-saving income is 4430. You all remember that basic rate band is 37,700. So 4430 into 20%, this will be 886. Then we have dividend income, 7,000. First 2,000, always go at 0% in dividend. Okay. And since our income lies in basic rate band, the basic rate band is still 37,700. So even if you add up both of them, it's like 11,000. So it is within the basic rate band. So remaining dividend income of 5,000 will be taxed at 8.75%. 5,000 into 8.75%. So it's 438. If I add up both of them, so this gives me the tax liability. And that will be 886 plus 438. So it's 1324. We will adjust the tax credit, the advanced tax, to arrive at the value of tax payable. Okay. So what is the tax credit? We grossed up 4,000 to 5,000. The credit amount is 1,000. The difference between net and gross. So 1,000 is the credit. So the tax payable will be 324. So a brief revision of the previous class. Okay. First, we classify the income in the relevant heads. Employment income is non-saving. Dividend income goes in head of dividend. REIT dividend. It's a dividend from a mutual fund which earns from real estate market. It is classified as a non-saving income. Withholding tax is 20%. So we need to gross it. So this all was already discussed in the previous class. Just a brief question to give you a reminder of what we have studied in the previous class. Now let's introduce a concept of our today's class, which will be the main concept, and then we'll be doing the practice questions on it. I want you all to listen to me very carefully. I'll repeat the things again and again to make sure that it gets settled in your mind. Trust income. What is trust income? Now, before talking about trust income, let me introduce the concept of trust. What is a trust? Let's first understand that what is a trust, and then we'll talk about its income. Similar to real estate investment trust, first I taught you that what is a REIT, and then we discuss the concept of income. So let's first talk about this word trust. See, trust is a body in which one party donor donates the assets. Trust is an artificial body, a registered entity in which the donor donates the assets. Those assets are managed by trustees, like board of directors. Trustees manage those assets, and the income from the trust is given to the beneficiaries. I'll repeat it again. Trust is a body, it is a registered entity in which the donor gives the assets, trustees manage those assets, and the income of the trust is given to the beneficiaries. Now, you must be thinking that why these trusts are created and what is the need of these trusts. See, sometimes we want to give income to some people who cannot manage that activity. Like, for example, if I'm managing different businesses and in some accident or something, I have very limited time to live. And I feel that my children are very small and they will not be able to manage that business. So what I will do is that I will create a registered entity. That registered entity will be a trust in which I will be giving those assets. I will be a donor. I will appoint a board of trustees to manage that trust. And I will write in the constitution that, okay, give income of this trust to my children, to my family, or to whoever I appoint as the beneficiary. So, what is a trust? It is a body in which the donor donates the assets. The donor is giving the assets. Those assets are managed by board of trustees, and the benefit, the income is given to beneficiaries. Okay, sir, why not make a company and make those beneficiaries as a shareholder? See, the problem is that these beneficiaries are young enough or immature enough to manage the trust. So if I will make them a shareholder, they will have to get involved in some element of decision making. The shareholder also have to take some decisions in general meeting. But if I feel that the beneficiaries are unable to manage this entire activity, making a company will not be advisable. So what I'm doing is that I'm creating an entity that is called as a trust, and that will be managed by board of trustees. Obviously, those trustees will be getting the salary. So why these trusts are created? To give income to those who cannot manage it, or sometimes the objective is to give income in a systematic manner. For example, what I feel is that after I'll die, maybe the people will start fighting or they'll mismanage the things. So I created a trust. I appointed the board of trustees and I instructed in the constitution that income will be distributed in this systematic. So the objective of creating trust is to give income to those who cannot manage it themselves or to give income in a systematic manner. But there is one more objective, and that is to do some tax planning. Now you must be thinking that how we can do tax planning through concept of trust. So listen to me carefully. When this concept of trust was created, primarily the objective was to facilitate those people who want to give income to those who cannot manage it. Like, for example, if I'm dying and I want to make sure that my family gets the income. So I will create a trust, I will appoint the board of trustees, and they will manage that business, they will manage that trust, and they will give the income to my family. The primary reason was, but there was one tax planning perspective which was created within it. What people started to do was that I'm alive, I'm not dead yet, I'm alive, and there is nothing to worry about my death. Now, I'm talking about the trust planning. What I do is that I will create a trust. I will put my entire business in the trust. I am the donor, and I will appoint myself as the trustee. Listen to me carefully. I'm a person, I'm alive, I have a business. What I'll do is that I will create a trust. I will donate all of my assets in that trust. I'll become the donor, and I will appoint myself as a trustee also. Now, what I will do is that I will manage this business as a trustee, and then I will distribute the income on my name and on the name of my family members in such a way that I will give everyone a certain amount of income so that the personal allowance of everyone gets utilized. Think about it logically. If the entire business is on my name, obviously my tax band will get higher. You need to listen to me carefully. It's some advanced taxation interesting thing. See, if I'm running a business and that whole business is on my name, the entire income will come on my name. If like I'll earn 300,000 pounds, my tax band will increase to additional rate back. So what I did, I was thinking. Oh, so I said, there is one option. Let's create a trust. Put the entire business in the trust. I'll become a donor and I will also become the trustee of the trust. Now the trust will earn 300,000 pounds. What I will do is that I will distribute this income like 30,000 pounds on my name, some amount on wife name, some amount on my father's, some amount on my wife, some amount on my mother's name, on my brother, sister, children. I will distribute it among my family members as a beneficiary income. Now, they all will be able to use their personal allowances and the basic rate banks. So there is an aspect of some tax planning in it. Now, again, some students will argue, sir, you can achieve this by creating a company also, make them all the shareholders of the company. No, 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 no. If I will make them the shareholders, they will have the ownership rights. I don't want to give them ownership rights. I just want to make them the beneficiaries, and the entire control will be in my hand because I am the donor and I am the trustee. I will keep on changing the things and I will make sure that everything goes as per my choice. Okay. So we'll go in further detail when we discuss the types of trust. So basically, trust is a body, it is a registered entity in which the donor is giving the assets. Those assets are managed by board of trustees and income is being given to the beneficiaries. Normally, the trust is created to give income to those who cannot manage it. Like, for example, if you have small children or you have a family who cannot manage the business, you will create a trust, you will appoint the board of trustees to manage it. Or if you want to give income in a systematic manner, like a proper distribution as per your instructions. Or there is objective to do tax planning. Now, there are two types of trust. One is discretionary trust and one is interest in possession trust. Now, this discretionary trust is created for tax planning objective. Okay. The word discretion means choice, your will, your choice, your willingness that how you want to make the things go on. Discretionary trust. This trust is created for tax planning perspective. Now, the important thing, this tax planning is permitted by the tax department. So there is nothing to worry. Okay. This tax planning is permitted by tax department. Now, what is discretionary trust? This trust operates according to the discretion of trustees. Now, how this trust operates? See, the trustees have full powers in this trust. Like, for example, those who are managing the trust have unlimited powers. They can change the beneficiaries. They can change the business of the trust. They can do anything. Now, basically, discretionary trust is created when we want to do tax plan. What I'll do is that I will give my assets to the trust. I am the donor, and I will appoint myself as the trustee. Now, trustee will have full powers in the trust. Okay, I will manage the entire business of the trust. And since in discretionary trust, full powers are with the trustee, I will change the beneficiaries, I will add the beneficiaries, I will remove the beneficiaries, I will do the tax planning to make sure that the basic rate band and personal allowance benefits are utilized. This trust operates according to the discretion of the trustees. They can take any decision in trust, which includes changing the beneficiaries, changing the activity of the trust, closing the trust, anything. Okay. Discretionary trust is created for tax planning purpose. Normally, donor himself becomes the trustee and he uses the trust for tax planning purpose. Now listen to me carefully. If your children are small, listen to me. If your children are small and you are dying, your death is very near. Like, for example, the doctor has said that you have only 15 days to live. You will never create a discretionary trust. Because if you will create a discretionary trust, all powers will go to the trustees. And they may misuse those powers. They may remove your children from the list of beneficiaries. If my children are small, or if I want to give income in a systematic manner, in that case, I will go for interest in possession trust. In this trust, the trust operates according to the instructions of the donor given in the constitution or his will. Here, the trustees are just the employees of the trust. See, try and listen to me carefully. When I talk about discretionary trust, when I talk about discretionary trust is completely in control of trustees. They can change the beneficiaries also. So if your children are small or if you want the income to be distributed in systematic manner, you will never create a discretionary trust because the trustee may defraud you. He may change the beneficiaries after your death. So what happens in discretionary trust is that the donor himself becomes the trustee. The only objective of creating discretionary trust is to manage the income tax. Now, how are you managing the income tax? That you are changing the beneficiaries, you are adding the beneficiaries so that you want to use the personal allowances and basic rate bands. Okay. So the discretionary trust is created for tax planning purpose. If your children are small or if you want the income to be given to your family, don't create a discretionary trust because once you will die, the trustees will take up all of the amount. In that case, we create interest in possession trust. IIP operates according to the instructions of donor given in the constitution or in his will. Trustees are employees of the trust and they have to follow those instructions. Here, the trustees cannot change the beneficiary. Okay. IIP is created when donor wants to give income to those who cannot manage it, like his children or family, or when donor wants to give income in a systematic manner. So we can discuss the concept of trust, that what the trust is. It is a registered entity in which the donor gives the assets which are managed by the trustees for the benefit of beneficiaries. Then we discussed that why the trust is created. So there are three reasons: to give income to those who cannot manage it, like for example, small children in the family, or if you think that your family will not be able to manage the business, so you can create a trust and that business will be managed by the trustees and its income will be given to your family as a beneficiary, or to give income in a systematic manner. And the third reason was to do income tax planning. Then we discussed that there are two types of trust. One is discretionary trust, which operates according to the discretion, the choice of trustees. Okay? In discretionary trust, the donor himself becomes the trustee and he uses the trust in order to do the tax planning. What the donor will do is that he will give his entire business to the trust and he himself will become the trustee. Then he will create his multiple family members as a beneficiary and will distribute the income of the business among those beneficiaries so that personal allowances and basic rate bands of the family members get utilized. Okay, now let's look at the taxation element. The income which we receive from discretionary trust, if we are the beneficiary and we are receiving any income from discretionary trust, it will be taxed as a non-saving income. Number one, it will be taxed on receipt basis. Receipt basis means the fiscal year in which you receive the income, in that particular fiscal year, in that particular tax year, it will be taxed as a non-saving income. And withholding tax, the advanced tax is 45%. Okay. From tax perspective, income from discretionary trust is taxed as non-saving income. It is taxed on receipt basis. This means that the fiscal year, the tax year in which it is received, in that fiscal year it will be taxed. Withholding tax, the advanced tax is 45%. Okay. So what is a discretionary trust? It is a trust which is created for tax planning. All the powers are of trustees. They have the discretion, they have the choice to operate the business, to change the trustees, to change the business of the trust, or even to close the trust. Okay? The only objective of creating discretionary trust is to do tax planning. If you want that trustees give the income to your family members, then you will go for interest in possession trust. Because if you will create a discretionary trust in that case, the trustee will take away your entire amount. Okay? Discretionary trust is created when the donor himself becomes the trustee and he uses the trust to do income tax plan. From tax perspective, discretionary trust income is taxed as non-saving income. It is taxed in head of receipt basis. Receipt basis means that when you will receive the income in that fiscal year, it will be taxed under the head of non-saving income, and withholding tax, the advanced tax is 45%. And if we talk about the interest in possession trust, what is interest in possession trust? This trust operates according to the instructions of the donor, which are given in the trust constitution or his will. Here, the trustees are just an employee. They have to follow the donor's instruction. It is created for real reasons, like if you want the income to be given to your family members or in a systematic manner. Okay? Income from IIP is taxed on accrual basis, because in IIP you have the right. The trustees cannot change that right. So your income is taxed on accrual basis. This means that even though you haven't received the amount in this particular fiscal year, but still, since your amount is accrued, that's why it will get taxed. Okay? It will be taxed on accrual basis because sooner or later, you will get the amount because the donor has instructed so. It is taxed as a non-saving income if the trust earns from non-saving or saving sources. Non-saving or saving sources means the non-saving sources are trading income, property income. If the trust earns from non-saving or saving sources, the interest income, then for the beneficiary, it is taxed as a non-saving income and withholding tax is 20%. It will be taxed as a dividend income if the trust earns from dividend source. Now, dividend source means that if the trust has some shares and the trust is earning dividends, then for the beneficiary also it will be a dividend income and withholding tax will be 8.75%. Okay, these all things will get clear when we look at the practice questions. Let me repeat it for you. I want you all to concentrate on it. What is a trust? It is a registered entity. It is a body in which the donor is giving the assets. Those assets are managed by the trustees for the benefit of beneficiaries. Okay. Why do we create this trust? Because we want to give income to those who cannot manage, like our family. For example, if a person thinks that he'll die soon, So he can create a trust, he can appoint the board of trustees, and he can define the constitution that the income should be given to my family or to XYZ beneficiaries in a systematic manner. He'll go for interest in possession trust. And if he wants to do the tax planning, then discretionary trust is created where the donor himself becomes the trustee and he uses the trust to distribute income among multiple beneficiaries. Okay, income from DT is taxed as non-saving income, withholding tax is 45%. Whereas if we talk about interest in possession trust, it is taxed as non-saving income if the trust itself earns from non-saving or saving sources. Withholding tax is 20%. Withholding means advance tax. If the trust earns from dividend sources, then it's a dividend income for the beneficiary and withholding tax is 8.75%. Let's look at 3 practice questions in this regard. You all know that my approach is that first we discuss the concept and then we do the practice questions so that the calculation approach, the mathematical part gets clear. Okay, let's look at it. I want you all to concentrate on. Mr. Z has following incomes for the year. Trading income 17,000. Income received from discretionary trust. Discretionary trust is classified as non-saving income. Okay. Discretionary trust is classified as non-saving. And since the examiner is silent, we will assume that the amount is net. We will assume that the amount is net. We need to gross it up. The withholding tax is 45%. Okay. On discretionary trust, the withholding tax is 45%. We have just discussed it. Dividend income is 25,000. I want you all to listen to it carefully so that things get clear. One head is non-saving and other one is dividend. Okay? Look at it carefully. Trading income, 17,000 goes in the head of non-saving. Then we have discretionary trust, 9,000. The examiner silent. Nothing is written that whether it is net or gross. So we assume that the amount is net and withholding tax, the advance tax is already deducted of 45%. So we need to gross it up. Just think logically. If 45% is already deducted, use your mind. If 45% is already deducted, the amount which we received is 55%. If 45% is already deducted, the amount which we received is 55%. So divided by 55, multiplied by 100. 16364. Okay? Discretionary trust 9,000. He is silent, so we assume net. Advance tax is 45%. So what we received is 55% divided by 55 multiplied by 100. 16364. And then we have dividend income. That is 25,000. So dividend goes in the head of dividend. Okay. Now let's look at it carefully. We will add up all of them to arrive at the value of total income. So 17,000 plus 16364. So it's 33,364 and this is 25,000. Okay. Then we'll deduct the personal allowance. The personal allowance is 12,570. We will adjust it. So we will arrive at the value of taxable income. Now, what's the taxable income? The taxable income is 12,570. I adjust, so it's 20,794, and this will be 25,000. What I believe is that I haven't done anything new. Trading income goes in non-saving. Discretionary trust is grossed up. 9,000 was the net amount, 45% withholding. So divided by 55, multiplied by 100. And then we have dividend. Total income, personal allowance to arrive at the value of taxable income. Let's calculate tax on it. Okay. Non-saving. 20794. Now this lies in the basic rate band. So entire amount will be taxed at 20%. Basic rate band is still 37,700. So this is 4159. Okay. Then we have dividend income. It is 20,000. First 2,000 goes at 0%. So this is 0. Now let's look at the basic rate band. Our basic rate band is of 37,700. You have studied all of this in the previous class already. Now let's look at the remaining space in basic rate band. 37,700 minus 20794 minus 2,000. So it's 14,906. Okay. Basic rate band, dividend income, 8.75%. So this will be 1304. How much is the remaining amount? 20,000 minus 2,000 at 0% and 14,906 at 8.75%. So remaining is 3094, 33.75%. I will repeat the things, so don't worry about it. So this is 1044. I will add up all of them to arrive at the value of tax liability. 4159, 1304, and 1044. So it's 6507. We'll adjust tax credit from it. Now, what was the tax credit? 9,000 was grossed up to 16,364. So the difference amount was our credit, 7,364. So we have a tax refund because we have already paid greater tax. So a negative tax payable, which means a refund, 6507. So it's 857. We can get that refund amount. I will repeat it again. I want you all to listen to me very carefully. The most important thing is patience and concentration. We'll do 2 more practice questions. The things will get clear. But you have to focus and listen to me carefully. Trading income 17,000 goes in non-saving. Nothing new in it. Discretionary trust 9,000. See, we studied. From tax perspective, income from DT is taxed as non-saving income. Withholding tax, the advanced tax is 45%. So divided by 55, multiplied by 100. 45% was the advanced tax, which was already adjusted. So we need to gross it up. Okay? We arrived at the value of total income. Personal allowance is adjusted to find out taxable income. 20794 goes at 20% because basic rate band is of 37,700. Then first 2,000 goes at 0%. Look at the basic rate band, remaining space. This goes at 8.75% and the remaining dividend goes in higher rate band. Okay. So except for discretionary trust line, everything which you did was already discussed in the previous class. See the practice again and again, again and again. Do more and more practice questions. This is the only key that you will understand the approach and the method of doing questions. Are you getting it? Okay, let's look at one more practice question. Okay, do this practice question with me, and then for the next, you should try it on your own. Okay, let's look at it. Mr. Z is following income for the year. Property income 16,500. Income received from IIP 8,000. Sir, which source is it? If the examiner is silent, we assume it as a non-saving source. Because in IIP, if it is non-saving or saving source, we treat it as a non-saving income. And withholding tax is 20%. Since the examiner is silent, so we will assume the amount as net. Okay? Dividend income is 37,000. Let's look at it. I want you all to concentrate on it. Again, a simple question. Now, we will make head of income, non-saving income, and other is dividend income. Listen to me carefully. Property income. Property income goes in non-saving, 16,500. IIP. It is not written that from which source IIP is earning. So we assume it as a non-saving source. Okay. These are the default assumptions. You have to use them in your examination also. The examiner is silent. So we assume that amount is net. In IIP, withholding tax is 20%. See, we have studied it here. It is taxed as non-saving income if trust earns from non-saving or saving sources. Withholding tax is 20%. If it would be dividend source, then withholding would be 8.7. But for dividend source, examiner will write that trust earns from dividend. Okay. So let's look at 8,000 divided by 80% multiplied by 100. Because 20% is withhold. So what you have received is 80%. So this is 10,000. Okay. Property income done, IIP done. And then we have dividend income. That is 37,000. Okay. We will add up all of them to arrive at the value of total income. 16,500 plus 10,000, it's 26,500. And this is 37,000. We will adjust the personal allowance. Personal allowance is 12,570. So we'll get the value of taxable income. Taxable income. 26,500 minus 12,570. So it's 13,930 and this is 37,000. Okay, let's charge tax on it. I want you all to listen to me carefully. 13,930. Your basic rate band is still 37,700. So this 13,930 goes at 20%. So it's 2,786. Okay. And then we have dividend income, 37,000. First 2,000 at 0%. So this is 0. And now we will look at the basic rate band. Okay. Now what's the remaining space in basic rate band? 37,700 minus 13,930 and minus 2,000. So it's 21,770. It will be taxed at 8.75% because we are taxing the dividend income. 8.75%. So it's 1905. What is the remaining dividend? 37,000 minus 2,000 minus 21,770. So it's 13,230, 33.75%. So this is 44,770. 1,265. I will add up all of them to arrive at the value of tax liability. 2786,1905,4465. So it's 9156. We will adjust the tax credit, the advanced tax, to arrive at the value of tax payable. Now, there was interest in possession trust. We grossed 8,000 to 10,000. So withholding tax was 2,000. We will adjust it. And our tax payable is 7156. Okay. So let me repeat it again. I want you all to concentrate on it. Now, non-saving income and dividend income, two heads. Property income 16,500 goes in non-saving. Interest in possession. The examiner is silent, so we assume non-saving source. And the amount is net. So we need to gross it up. Why gross it up? Think it logically. Now, because the examiner has not written that the amount is net or gross, so we assume that the amount is net. Withhold is 20%, the advanced tax. So we grossed it up. 16,500, 10,000, dividend goes in dividend. Add up all of them, arrive at total income, adjust the allowance to get the taxable. Now just looks at the tax bands. Just look at the tax band and the things are simple. Non-saving, basic rate band, 20%. Dividend, first 2,000 at 0%, so it's 0. Now the remaining space in basic rate band, 13930, 2,000, minus 37,700. The remaining space, 8.75% is the basic rate of tax of dividend. The remaining amount goes in higher rate band, okay, the tax credit, and we arrive at tax payable. I particularly believe that there is nothing difficult in it. It is just about remembering theory, because the examiner can ask it for 2-3 marks, and the calculation perspective. Okay? I want you all to try this practice question. One last practice question for today on your own, and then we'll try. Okay? Pause the recording and try. I am continuing the class, but you can pause the recording and first try it on your own and then watch my recording. Okay? So let's look at it. Okay. Mr. JS following incomes for the year. Property income 18,000. Income received from DT 10,000. Okay. Now the income of DT is classified as non-saving income. Examiner has not written anything, so we assume that the amount which is given is net. Withholding tax, advanced tax of 45% is adjusted from it. Dividend income is 20,000. Let's look at it. We will classify the incomes, non-saving, and the second column is dividend. Okay. Property income. It is 18,000, goes in the head of non-saving. Discretionary trust, 10,000. 45% is the withholding tax. So what we have received is 55%. Divided by 55 multiplied by 100. Think logically. If 45% was already deducted at source, so what you have received is 55%. 10,000 divided by 55 multiplied by 100, so it's 18,181. Okay. And then we have dividend income. Dividend goes in head of dividend, 20,000. Okay. So let me repeat it again. What we have done is, we have first of all classified the income, property income in non-saving, discretionary trust non-saving. We grossed it up, and dividend goes in column of dividend. Okay. Now, We will add up all of the incomes to arrive at the value of total income. 36,181 and 20,000. Clear? We'll adjust personal allowance. Personal allowance is 12,570. So we will arrive at the value of taxable income. Taxable income. Now, 36,181 minus 12,570. So it's 23,611 and this is 20,000. Let's charge tax on it. I want you all to concentrate. Non-saving income, 23,611. The basic rate band is still 37,700. So entire amount at basic rate band, 20%, 4,722. And then we have dividend, 20,000. So first 2,000 goes at 0%. So this is 0. And then let's look at the basic rate band, 37,700. What is the remaining space in it? 37,700 minus 23,611 minus 2,000. So it's 12,089. And since we are talking about dividend income, so it's 8.75%. So this gives us 1058. And here comes the remaining dividend. 20,000 minus 2,000 minus 12,089. So it's 5,911, 33.75%. So this is 1,995. Okay? We'll add up all of them to arrive at the value of tax liability. 4722, 1058, 1995. So it's 7,775. We'll adjust the tax credit from it. Arrive at the value of tax payable. What's the tax credit? We grossed up 10,000 to 18,181. So it's 8,181. And we have a tax refund. 775 minus 8181. So we have a refund of 406. So if we sum up our today's class, if you remember, when we started our today's class, we did one practice question, which was a revision of dividend income concept, which we discussed in the previous class. Then we introduced the concept of trust. Trust is a registered entity. It is a body in which the donor is giving the assets managed by the trustees for the benefit of beneficiaries. Discretionary trust, interest in possession trust. And then we did these three practice questions to give you clarity on the approach on the calculation aspect. I particularly believe that there is nothing difficult in it. But still, if you have any question, you all have my WhatsApp number. Feel free to contact me. Feel free to message me and ask any question which you have relating to this class. If you have understood the concept, do send a thumbs up. Right? Write down that, sir, we understand. It's going good, so that it motivates us. Okay? So the last practice question, which you must have done on your own, property income, discretionary trust was grossed up, dividend. We added up all of them, total income, personal allowance, taxable income, and then again the same tax balance. Okay? So we'll continue further in the next class. We'll first do one practice question, which will relate to the current class concept. And then we'll move forward towards a new concept of saving income, the interest income. Okay? See you all in the next class. Thank you, everyone.